So 2025's ended up as a hell of a year. Like, where are the markets? Where did we end the year and what's going on out there right now?
One of the biggest changes for 2025 was CoreLogic rebranding to Cotality, because
Still tripping me out.
I'm still wrapping my brain around that and getting used to calling them Cotality. But these guys are the bee's knees. These guys have so much information when it comes to the Australian property market. And it was a great year. You know, basically every single market went up over the last 12 months, which is really exciting. This was based off the 4th of December, 2025. So we're getting a really good snapshot there. Now, Darwin came through as a top performer over the last 12 months, going up 17%. So what an insane year. I know one of our colleagues, his brother lives up there, and he's been telling us how much he absolutely has crushed it and is loving the growth rate. So Darwin absolutely having a tear after some bad years, let's just call it that.
Now, one of the slow burners that not many people are talking about at the moment in Australia is Darwin. Now, Darwin's expected to do anywhere between +3 and +10%. But after looking at 19 major markets in Australia across about 4,222 suburbs, Darwin, statistically speaking, is Australia's most undervalued capital city in the market. And at some point, things will have to start turning up there, which may be this year or the year after.
Yeah, we could see the writing on the wall. I once again missed that opportunity, but it is all good. You're never going to get every single one right. But let's break it down. So starting with the big markets, Sydney up 5% over the last 12 months, Melbourne up 4%. I find that really interesting because I recently did some videos on Sydney and Melbourne looking at the top performing suburbs. There was suburbs in Melbourne that went up by like 29%, and there were suburbs in Sydney that went up 34%. So it's very interesting to see the balance and the difference across the entire market.
And as we've always said, there's no like Sydney market or Melbourne market. Sydney is 800 suburbs. Melbourne is over, 600 suburbs?
Over 1,000, yeah.
Oh, wow.
Now that Melton's opened up to it, yeah, crazy.
So obviously there's winners and losers within that, and there's pockets of cities within that too.
That's right. Now, Brisbane was up 12%, Perth 13%. So these two have been playing fisticuff for the last few years now, both being Australia's top performers over the last 5 years. Adelaide, 8%, Canberra, 4%. So across the board, great year. Hobart also went up marginally as well, I think 2 or 3% over the last 12 months.
So like you said, if Sydney did 5% in the year, but then there were suburbs that did as much as, did you say 39%?
36%.
36% growth. Where was the growth coming across the major capital cities this year? Was it in the top end of the market? Was it at the bottom end?
No, well, the top end was doing a little bit better because we had declining interest rates, which obviously positively impact growth rates across the board. But it's really that lower end of the market. The lower to middle end of the markets is what's driving the capital growth rates, because these are the more affordable areas. It doesn't cost you as much money to get into those locations. Sometimes they generate a bit of a better rental return as well. And we know that about 35 to 40% of properties that have been bought are through investors at the moment as well. So it's a lot of the investor market that are driving up those growth rates. And in Sydney, the top performers were like Blacktown, Yagoona, Lakemba, those types of locations. In Brisbane, it was your Logans and your Ipswich areas as well that were driving those growth rates. Interestingly enough though, Melbourne, some of the most expensive suburbs with median house prices above $2 million were driving it, which is kind of normal because generally it is that top end of the market that does start early. But there were some affordable suburbs like down in Frankston and out towards Melton that were really crushing it down in Melbourne over the last 12 months. So that market's a little bit difficult to figure out. But yeah, definitely in Sydney, Brisbane, Perth, it was those lower end of the markets that were driving everything up.
So before we get into talking about some of the predictions for 2026 from the likes of CBA Bank, SQM, Cotality, and the big dogs out there, are our old favourites, what are some of your questions / concerns going into the new year as an investor? Because you and I are both looking literally as we speak again at the moment.
It's been a hell of a 5-7 years across Australia, like, you know, Brisbane, Perth, Adelaide, Sydney, Darwin, regional Queensland, regional WA, regional South Australia, you know, across the board have absolutely crushed it. And as we look forward, it's unlikely that the next 5 years are going to look as good as the last 5 years. And based on what a lot of people are expecting is those growth rates are still going to continue in those markets, but we're going to start to see Sydney and Melbourne start to recover a little bit as well. Now, It's all dependent on a few things. I think interest rates being the biggest driver of property values. Generally, when interest rates go up, it does affect the more expensive markets and the top end of the market. And as those interest rates continue down, it positively impacts basically everywhere. So we'll have to wait and see. You know, according to the last quarter, it looks like inflation is back. And that's probably going to give the RBA some cause for concern and maybe leave interest rates at where they're at or potentially even push them up. So we'll just have to wait and see what comes out of the first quarter in the new year. And then population growth rates. They have been declining since the 22-23 financial year. Still at massive levels, over 400,000 people per year coming to Australia at the moment. But that's a lot less than the 650,000 that came in back in the 22-23 financial year. So I guess we just have to keep our finger on the pulse, wait and see what happens with interest rates, what happens with inflation, what happens with population growth rates. But what we're about to get into now is the 2026 market predictions, where basically across the board, everyone is saying that demand is outweighing supply, and that's obviously going to drive property values up even higher. So I'm keen to get stuck into it. I'm going to hand the sheet over to you, and we're going to get stuck into obviously what the future holds. Now, nobody has a crystal ball. Nobody knows what's coming next. But at the end of the day, it's fun to have a bit of a look at what the experts are saying, starting with SQM, because last year they kind of crushed it in terms of their scenarios and what actually happened. So what's SQM saying is going to happen in 2026?
So one of my favorite things that you guys can go and check out is the SQM Boom Bust Report. Simon and I have probably been buying that 10 years in a row now, at least. Generally, it looks at 4 scenarios. Like, there's a huge amount of information on each of the capital cities and some of the biggest regional markets. But the 4 different scenarios are basically from what might happen, best case, worst case, and something in the middle. And so in today's example, or today's numbers, the base case, which is the most likely scenario according to SQM, would be a 0.25 to 0.5% rate cut. If that happens, that would be beautiful, as well as a slow economy. So I heard something recently from Phil Anderson, who wrote The Secret Life of Real Estate and Banking, and he said, what happens at this stage of the cycle is the artificial economy, which is kind of like the big AI stocks, maybe crypto, maybe sort of silver and gold, like the more speculative things, go in one direction, and the real economy is kind of sitting flat or declining. And so with that in mind, it's a slow economy with inflation sitting at somewhere between about 2.5 to 2.7%. So that's the base case. Now, based on this scenario, Sydney is expected to do 3 to 6%, Melbourne 4 to 7%. Brisbane is in for another phenomenal year, 10 to 15% growth. Perth, man, 12 to 16% growth. Adelaide, 10 to 14%. And then Canberra sitting at somewhere like 3 to 6%.
So it's going to be another great year in 2026, according to SQM. I personally actually think that the scenario number 2 is probably more likely, because I think he wrote this before that inflation data came out. And then now that we know that inflation's back above 3%, his second scenario was based on, once again, a slower economy, but sticky inflation, hovering just above that 3% rate. And in this scenario, he was anticipating that rates may sit flat for the majority of 2026, and we may see a small decline towards the back end of next year. Obviously, that looks pretty likely based on what we're seeing, what CBA has indicated. I was watching Mark Boris's podcast recently, and he was sort of indicating that it looks like this is going to be back and it might stick around as well. So what were SQM indicating will happen if inflation is sticky and remains a bit higher than the expectations, and if interest rates don't drop?
So basically, for all of the key markets like Sydney, Melbourne, Canberra, and Adelaide, it's effectively just pulling those original numbers down by 1 or 2%. So instead of 3 to 6% in Sydney, it's just 2 to 6%.
Okay.
But when we look at the bigger markets that are predicted to do extremely well, the likes of Brisbane and Perth, in Brizzy, they're sort of saying 8 to 12%, even with sticky inflation and no rate cuts, and Perth at 10 to 14%. So it's certainly not something where he seems overly concerned one way or the other. At this stage, there are markets in Australia that are affordable, like Brisbane, Perth, Adelaide, and Melbourne still. And then there's some places that are pretty expensive, like the Goldie, Sunny Coast, maybe Newcastle, Wollongong, Canberra, and Sydney. But ultimately, it's kind of always been like that. There's normally places that have potential that are undervalued, and then there's places that are fully recognised in this particular stage of the cycle.
And you and I were looking back at the history, and we send this out in our monthly property market update as well, which is the long-term averages of interest rates. And basically, they're constantly fluctuating and it doesn't have a huge impact on property prices. I remember going to the Phil seminar down on the Gold Coast, and he was saying that 10 of the 11 interest rate rising cycles over the last 70 years, property prices went up in every single one of them. So I think something that matters more so than interest rates is supply versus demand. And because it's looking like the demand is going to outweigh supply, there's a lot of bullish predictions coming out there. And Domain appeared to be a little bit more conservative and maybe not such ambitious projections, but what are they sort of indicating could occur in 2026?
Theirs are actually super different. Like, I'd be interested to see where Domain versus SQM end up landing, because it's almost like the opposite. So they're saying Sydney could be at 7%, Melbourne 6%, Brisbane and Perth at 5% growth, Adelaide at 4%, and Canberra at about 4%. So it's funny, it's almost like someone over there just from like biggest number of people living in a market to worst just took 1% off each of them as they went through. We never know what's going to happen next, but Domain is historically significantly more conservative. Domain, from my experience of following this data with them for 5 or 6 years, has a higher percentage chance of, based on what I've seen in the past, being a little bit off across the board. But I like conservative, because if theoretically you bought a house for 600K in 2026 and it went up by just 5% a year for the next 15 years, it's doubled in value. Your 600K is worth 1.2 mil now. So conservative is good. If I could get a flat 5% for the next 20 years as an investor, I'll be financially free and well off in the future.
And the interesting thing is, as we said, like, these are big markets and there's markets within those markets. There's winners and losers. You know, some suburbs are going to decline in value. Other suburbs are going to boom in value. Others may just sit flat or hit these averages as well. So it does become really important to really understand how to assess one suburb versus another in these major metro markets where you've got millions and millions of people that live there, to sort of separate the forest from the trees and really understand, okay, what is driving these boom conditions in certain pockets or certain suburbs versus why are these other ones really struggling at the moment as well?
I think that's so important what you just said, because in Brisbane, for example, right now, 10, 11 years ago, when we were buying the northern, eastern and southern beaches of the city, the northern beaches we were buying homes for 400 to 500K that are probably now worth, what, 1.1 to 1.2 plus, conservatively. Like, they're the shitholes.
I was talking to a client recently and I was looking at their realestate.com link on the property that we purchased for them back in February this year. And it said that it was up 5.1% over the past month and up 12.8% since it was last sold. And that was less than 7 months in Redland Bay. I was just like, oh my God.
You know, and that's North Brisbane. So if some of those properties have gone from 4 to 500K to, 1 to 1.2, versus the other side of the city, we used to buy properties down there for sort of 650 to 700K. And now they're only worth 950 to 1.1. So even in that example, one particular part of the city statistically has done almost double to the other. And so if you're not just going Brisbane as a bag of goods is good enough, but you actually rip it down to the 423 suburbs like we have, you'll see even along the coastline, not even looking at north, middle or south or west Brizzy, there is little bits of gold around that is statistically so undervalued still. You've just got to know where to find it.
Now, something that I'm really curious to understand, because like, it's not all about capital growth rates, that's
what else is it about?
That's what most people invest for, leverage capital growth for sure. But at the end of the day, you got to pay the bills. Cash is king. And there was a period there from like 2020 through to 2023 where the rents on my investment properties and our clients' investment properties were just skyrocketing. But since then, they kind of haven't had the same growth. But what is SQM indicating could occur when it comes to rental growth across the country? Like, is it going to be easier to pay those bills, or is it still going to be tricky?
Look, based on what SQM's saying, like rents across every capital city in the country is supposed to go up in the new year. And if interest rates come down, then obviously the cost of holding is lower, the cost of rent is, or the income from rent is higher. So Sydney, they're expecting a 2 to 4% jump in the new year, 2026. Melbourne, 1 to 3%. Brisbane 3 to 5%. Perth is looking incredible according to SQM, 4 to 7% rental growth. Adelaide 1 to 4, Canberra 2 to 4. Darwin is going from strength to strength, 5 to 9% rental growth. Hobart too, 6 to 10%. So good old Hobart went through a doubling after COVID with everyone moving down there. Has stabilized for a while, and actually statistically, even though it's super expensive, it doesn't look too bad.
Now, one of my old favourites was Heron Todd White, HTW. They do a monthly report where they kind of take a snapshot of the entire Australian market, and they give you a little bit of an indication as to where they perceive these markets to be situated within the property clock, because everyone hears, real estate or any investment really runs in cycles, and there's good times to buy, there's bad times to buy, there's good times to hold. And on this property clock, it sort of gives you a bit of an indication as to where the big capital cities are and where some of the major regional markets are located as well. So from a timing perspective, even though it's a short-term focus, where are they indicating, or where are they saying are markets that are like at the bottom or maybe in a rising stage, or where are the ones that are getting closer to the peak at the moment?
And Simon and I religiously read this report probably every single month for 4, 5, 6 years.
Yeah.
What's interesting about this report is from one month I've seen it at top of market to the next month being at the very bottom. So with all of this stuff, guys, not even SQM or CBA Bank or Elon or Chat, can fully forecast the future. We're all trying to do the same thing, which is take as many data inputs as we can to make a decision. So top of the clock, 12 o'clock is, top of the market. And then 3 o'clock's declining, 6 o'clock's bottom, 9 o'clock's rising. Mine and Simon's favorite place to buy has always been when the market that we're in is sitting at either 6 o'clock or 9 o'clock. 9 o'clock gives me a lot more confidence personally, because people had to sit at the bottom of the market in Perth before it ran for 14 years. It's a long way. But in terms of what HTW or Heron Todd White's saying in their month in review report, Sydney is in the rising stage of the cycle, and we've probably seen that in the numbers last year, plus the predictions for the new year. Melbourne's at the start of the recovery, my personal favourite place to buy. Brisbane, Perth and Adelaide are all at 9 o'clock in the rising phase. In fact, almost all of Australia is, like you see it heavily loaded there. Canberra is not even on the clock right now. This happens. I've seen even Sydney before disappear out of the clock for a while when it's like, shit, we don't know.
Yeah.
And then Darwin's in the rising phase too. What I love about it is it's a quick little pulse check that they actually give that incredible report away for free, but then you can actually read into each capital city and regional market. And it's been really helpful, not just to see where things might be at, but it gives really different perspective over the 12 months of the year. So it'll go into population in one report, then it'll go into infrastructure, then it will go into job growth and housing approvals. And over the course of a year, you can get a really deep education into the market you're thinking about buying in or the market you own.
One thing that I remember when we just briefly looked at it as well was that most of the markets that are in the, I guess, from 12 o'clock to 6 o'clock in their declining phase were basically all regional New South Wales. So, we'll just be cautious of that, I guess.
Yeah, I love that too. Yeah, because we are good at talking on the hype side, but there are a few markets, without throwing any under the bus, that I would avoid pretty much like the plague for the next few years, and maybe we'll share that in future apps.
Yeah. Now, the world's changed. We used to do these videos, and we've been doing these property market predictions for over 5 years now. And we've always just had to manually search all of this sort of stuff ourselves and do a lot of the research ourselves. And we still do, but one of our clients is like obsessed with AI, and one of our colleagues is also obsessed with AI, and it's 2025. It's only going to get bigger and better and become more of a part of life. And so we did a cheeky little one to look at what AI is actually indicating for the Australian economy, for the Australian property market. It wasn't chat, it was actually Grok, which I think is Elon Musk's one, is that right?
Yeah.
And so what is AI sort of taking? And like, we couldn't go too deep into this stuff because it was picking stuff up from everywhere. Like all of the major consulting firms, all of the major economists, analysts, having access to all of that free information without being able to go behind some of the paid walls. But all the stuff that we looked at today is out there for free as well. So it clearly has access to the same info that we do.
So this was from one of our clients, Ray. Like, thank you so much, Ray, for the last 6 years. Like he's been sending us the most incredible stuff from the major banks. He worked in corporate banking for most of his career. He's more obsessed with data than anyone I've met. And so what he did, he actually plugged in 5 different AI tools, and he got them to sit with different hats based on conservative to least conservative. And then he actually gets them to constantly debate all night, 24/7, 365 days. And then it's pulling data from all the sources you said, the major banks, everything that we talk about, even crime, building approvals, HIA, all of the major consultants globally as well. And as him and I laugh about via email when I'm like debating him on what it's finding and he's going back and forth, he's like rubbish in, rubbish out. So we're trying to get this thing more and more and more, because it's like $600 a month what he's paying for here. Like he's like at a premium level to try and get the best stuff. But I'm just like, I heard this, can you put it in? Can you put in all of Phil Anderson's 18.6 year cycle stuff, Fred Harrison's stuff, all of Akil's stuff? Can you put in everything from Buffett and Bridgewater? Can you like put everything in from a stock perspective you can find from the greats, from the top 30 companies? Like, it's getting so deep now.
We put it, like when I did this with chat, I put in that 46-year article that looked at Sydney, Melbourne, Brisbane, Perth house prices. So it analyzes all of that information as well.
Another cool source out of Grok, chat, and then I suppose something that we're loving at the moment, one of the boys in the office is really into his H tags.
Yeah, H tags, great.
It's got 50 to 60 years worth of data we just found out in it, and it's really cool to look at certain time frames versus others. We'll go into that more in a moment, but according to like what Ray and I what Ray was looking at, and I was just being a pest asking him stuff before, was effectively which markets have the most upside potential in the next 5 years out of the top 4 capital cities in Australia. Because ultimately, if 82% of Australia's population live in Sydney, Melbourne, Brisbane, Perth, and then we go, okay, well, Sydney's got Newey and Wollongong, Brizzy's got Goldie, Sunny Coast, Melbourne's got Mornington and Geelong, Bendigo, Ballarat. We get a good sense of what's going on from those major markets. Number 1 in the next 5 years is expected, according to these guys, to be Perth. Brisbane's number 2. Number 5 is Melbourne. So there's obviously other markets in the mix there that aren't being factored in here. And number 7 out of the top capital cities is Sydney. What was interesting though is it weighted a whole bunch of stuff, which honestly, it's like seriously technical. Like some of it I can't even honestly read, just full disclosure. But Perth and Brisbane in particular, the 2 mining states in a commodities boom at the moment, could do as well as 8 to 13% growth per annum over the next 5 years. And that's in alignment with some of the things we've read out of the Australian Financial Review. Like Brisbane in 2026, according to SQM, is expected to do 10 to 15% based on base. Perth at 12 to 16%. But there are analysts out there from the major banks at the moment suggesting that the average in Brizzy could go from $900K to $1.4 million by the games, or even higher than that on the beaches. So there's a big push, and we're feeling it physically in the market. Like in Perth, which we're not buying at the moment, I know it's hot because I can see the quarterly data has spiked massively. And Brisbane is going ballistic. Like I've seen places online for $695 that sold and had 56 offers on them in 3 days for over $805K. Like it's hot out there, about as hot as I've seen it since the start of COVID.
It's pretty interesting to hear, obviously with a mining boom and obviously a commodities boom globally, that's always going to positively impact Queensland, WA and the Northern Territory. Because there's so much underneath the ground in those states and happy to pull it out and send it offshore, which is amazing. But it's interesting because like when I hear that, and this is just Simon's opinion, it doesn't really have that much weight, so don't take it all with a grain of salt. It's like what I'm hearing there is they're taking the last 5 years and they're using that as a way to predict what could come next. Because I read some information from the Australian Bureau of Statistics that was actually indicating that Western Australia will be Australia's most oversupplied market by 2030. And generally an oversupply isn't super conducive to property price growth. So it'll be interesting to see how it all comes together. So I guess nobody can predict the future, not even artificial intelligence. So once again, take everything with a grain of salt. But in the short-term future, it is looking like the show continues to stay on the road and that gets me super excited.
You know, when I think about myself as an investor for 2026, which I think is important, right? Like we've bought over $700 million worth of property now.
Wow.
And, through that, it's not just the lessons you learn from being in the market every day, but it's the lessons you learn from talking to seriously smart people. Like we've got multiple clients now with $30 to $50 million portfolios that get us to do their resi stuff. That have other people that help them with their commercial stuff that also do stocks and crypto and run good businesses. So what I would say, the lessons that I've learned from them is when I look at a new year, the first decision I'm always looking to make is, am I going to buy? Number one. The second decision is, can I afford to buy?
That should be your first one, to be honest.
Yeah, that's probably number one, actually. It's like, well, I've always got a desire to buy. It's like most of the time it's like you can't afford to buy anything here. But if I look at, let's go Sydney versus Melbourne first, because generally, if 75% of that 82% I talked about before is between Sydney, Melbourne and Brisbane, or Southeast Queensland, Sydney and Melbourne, then, that's where I like to buy. I like to buy where the people live, where the big jobs are, where the great lifestyles are. So if I could afford to borrow money, and then I start to think about, well, there's either Sydney versus Melbourne, right? And then there's Brisbane versus Perth.
Yeah.
So the idea that I had for most of the last 10 years is that Sydney and Melbourne were equal. And from an income perspective, from an opportunity perspective, from a size perspective, that's pretty much right.
From the last 30 years perspective, it's basically the same as well. There was not that much difference between Brisbane versus Melbourne. Sydney versus Melbourne from 1992 to 2022, according to the Cotality report as well. So their percentage return on investment, same.
Yeah, actually, that's so true. Like when we looked at 1970 through to 2016 as a period, I think when we averaged the total return divided by the 46 years, Melbourne did 9.5% and Sydney did 9.6%. So you're completely right. Like long term, it was splitting hairs. Right now, East Melbourne and some of the beaches are exactly the same prices as Sydney. Like they are super expensive, and that was the category I put Melbourne in. But as I've actually broken down Melbourne into suburbs with you and looked at it, some of it is super cheap. So if you were to look at like South Sydney, right, Sutherland Shire, or, inner northern or inner western Sydney, like that sort of circumference of between about 19 and 30 k's from the city, the prices in Sydney are literally 60 to 100% more than they are in Melbourne for the exact same thing right now.
Well, I did a video on this recently as well, and we picked out a couple of suburbs, and one of them I picked out in Sydney was Sylvania Waters, with a median house price above $3 million. It was 19 kilometres from the Sydney CBD, on the water, beautiful suburb, beautiful location. We did the same for a suburb in southeast Melbourne, one suburb west of Brighton. It was about 18 kilometres from the CBD. The median house price was about $1.2 million. So that's indicating that it's far more expensive in Sydney than Melbourne, like for southeastern suburb, less than 20 k's from the city, blue chip suburb, high income earners, good schools, all of that jazz. So it's more than that.
That's interesting. So that was the biggest thing that I learned in 2025, that Melbourne is significantly more undervalued than Sydney. And It even came out in the financial review, and I think they said that the difference between Sydney and Melbourne in house prices historically is sat over a 30-year period at about 29% difference. And as of 2025, the difference was now up to about 60% on average. And I've found, and you found, suburbs that could be 100 to 150% differential in the same market. So if it was me, I like the idea of Melbourne a lot more than I like the idea of Sydney in 2026. But then if we go to the Brisbane versus Perth comparison, Perth is clearly expected, according to everyone, to outperform Brisbane short term. And that'll probably be a self-fulfilling prophecy, which it normally is, for a whole bunch of different reasons. We know the incomes in Perth are the highest in the country, now closely followed by Queensland, just because of the commodities boom up here has had a big effect on jobs. But what's interesting is not the recent history, because in the last 5 years, like you said, Brizzy and Perth have gone ballistic. There's almost not a suburb we've bought that hasn't doubled in value in that time. But if we take a longer snapshot and we go back to the last big commodities mining boom, so let's say between 2001 through to about 2009, both markets in that time did over 120% growth. I think Perth did 140%. But when we hit the top, and like as Warren Buffett said, like, let's see what happens when the water drains out where everyone really is. The difference was Brisbane sat sort of flat before it took off again, where Perth took 14 years to sit flat. But in that period where it sat flat, a lot of people came back to Sydney, Melbourne and Southeast Queensland. Vacancy rates went from 1% where they are right now to as high as 16%. I talked to a lot of clients when we originally started the business back in 15, 16, 17 that had properties in Perth and wider Perth that were worth $1 million at the peak that they could not sell for 600 grand and had rents at 800 a week, and they couldn't find a tenant. Their houses were vacant for 3 to 6 months and renting them out for 400 a week. So when I look at both of them on paper, both have phenomenal incomes, both are expected to crank, both have low vacancy rates, both have all the stuff right now. But what happens when the water drains? And that's why I'm choosing, especially with the Olympic Games, which is an extra kicker that Brisbane has, Brisbane over Perth. So it's Melbourne over Sydney for me in 2026, Brisbane over Perth in 2026. Probably I might get that wrong. It sounds like Sydney and Perth are going to outperform, but with my own money, I'm looking at it as a 5, 10, 15-year outcome. Instead of a outcome that's like what's going to happen this year, because short term is important to me, but longer term is significantly more important, as is risk to reward rating.
And I've personally, over the last 2 months, analysed all 4 of those capital cities and the top performing suburbs. The top performing suburbs in Sydney, Melbourne, Brisbane and Perth have all roughly been the same return. So knowing what we know and our ability to analyse suburbs and identify that needle in the haystack, you know, I feel so much more confident going to the markets that have got that stability, because when the water drains out, those fundamentals really matter. And I think they are really evident in Sydney and Melbourne, in Brisbane, and Perth is going to get there. It's going to get there. It's already so much more economically diverse now compared to the last time around anyway. Like, you talk to anyone that lives in Perth, they love it. It's such a nice city. It's so beautiful. So I think all of these over the long term have really great opportunity, but short to medium is where we're talking about. And it's like, if Sydney and Melbourne have averaged the same long-term percentage return on investment, but from an affordability perspective and a rental yield perspective, I can get so much more bang for my buck in Melbourne, then it's an easy decision for me. And then obviously Brisbane versus Perth, you know, they're just, obviously Perth's done really well. Will that continue? Maybe in the short term, uncertain in the medium term. And then in the long term, it's a great market. We all know that anyway. So obviously time will tell, right?
Time will tell. Like, at the end of the day, all of the analysts across the board are expecting the things that are fundamentally meaningful for property. So semi-stable interest rates, like, they may go up 1%, they may come down 1%, who knows? But we're not talking about going from 2% to 7%, according to the analysts at the moment in 2026. Money is everywhere right now. Like, the banks are certainly open. They're lending to super funds, trusts, companies, individuals. The first home buyers grants are back in the biggest way that I've seen since 2011. There's grants everywhere for building, for stamp duty, for lenders' mortgage insurance, and we've done other videos on that if you want to check them out. Population growth, according to the Australian Bureau of Statistics, will be another 500,000 people in 2026. In most markets, but not all, building approvals are far lower than the population growth and demand. So in most markets, we've got an undersupply. Within 5 to 10 years, most markets will be again oversupplied. That's what we do. There's only boom and bust in property. There's no middle. Trump in the US is talking about 50-year home loans.
And Boris Johnson.
Yep, so that's going to happen. What that conversation is about is a leverage play, which is people are hitting affordability constraints, and that means the economy will slow. What that effectively means is if I could go on an interest-only 50-year loan versus an interest-only 30-year loan, my repayments to the bank week to week are going to be significantly under what my repayments would be on a 30-year term. And then if we get these, bloody hell.
That's a slippery little book, that one, eh?
If we get a...
Got Joe Dirt in there spraying on the olive oil or the canola oil.
If we see a interest rate reduction on top of this pop growth, on top of 50-year loans, on top of easy money, on top of an undersupply, like we're talking about a few of the things that are a perfect storm for growth. And what I will say, not ending it in a negative way, is just be aware in 2026. Like there'll be winners and losers in cities, there'll be winners and losers with properties in suburbs. But we both know, and all of you guys know, how quickly good can turn to bad. And we're getting closer to the pointy end of the cycle, which means it's more important in 2026 than ever to be safe, to talk with your accountant, and to be reasonable and semi-conservative in your approach. Like, I don't love the idea in 2026 of going out there and buying something that's done 150% in the last 10 years when you can go out there and buy something that's done 30 or 40% in the same time. I don't love the idea of just because you can borrow $1 million going and spending every cent when you can go out there and get great properties at 700K in the best markets in the country.
What I love about it as well, and this is what's going to come through the media soon enough, is the changes to APRA. Like, we have such a conservative banking system, such a conservative economy, and they're no longer going to allow any more than 20% of loans written across the board to be for households with a high debt to income ratio. So they're bringing back the 6 times rule, except for a few individuals, first home buyers, single parents, unique situations. So once again, the Australian Prudential Regulatory Authority, APRA, is stepping in and going, hey, no more risky lending. We've seen what you guys have been doing. It's too much. Let's pull the reins back a little bit. And that's why we're not going to see these record-breaking capital growth rates across the board like we saw in 21, 22, 23. And obviously they can see the long-term horizon, and they know what happens when mortgage brokers just keep writing up these dodgy loans, and they're trying to protect Australian households, which that's one thing I freaking love about this country is we've got a government, we've got these regulatory authorities that have got our back and that are protecting us as well.
No, I think that's cool. So just to round it out, overall 2026, according to all of the analysts in the country and the major economists, across the board looks like it's going to be, at least predictions wise, a solid year. But as always, we'll just sort of see what plays out. I just love recording these, man. They're just so fun today. So thanks for the opportunity to do it today. And I'm going to be a buyer in 2026. I'm actually negotiating on a property at the time of recording this. I think you're buying again as well.
Yep, I'm in. I'm 100% in. So I've been setting up a self-managed super fund because I'm tapped out in my personal name. Not tapped out at the moment, but I've got more opportunity in the super fund. So I'm really excited to be back in the arena, to be a buyer again. I've figured out the market, a handful of suburbs that I'm going to focus on. I've got a really clear strategy that I'm looking to implement between now, December, and I will have purchased before the end of January. That's my goal.
Awesome, bro. Well, yeah, we're excited to show you that stuff as we pick them up over the next year, and we wish you all the best moving into this new stage of the cycle. Certainly looks pretty bullish at the moment. Let's see what happens. G'day guys, my name's Ben and I'm the director here at Pumped on Property, and I just want to say a massive thank you for watching our content today. Now, if you're thinking about buying an investment property in the next 3 to 12 months, then the team and I would love to offer you a one-on-one strategy session. In that session, we can talk about exactly where you are right now, where you'd like to be longer term, and we can deeply educate you on the Australian market. And then you can take that information and go and absolutely smash it on your own, or potentially become one of the small number of clients that we work with each week. To book your session, all you have to do is go to www.pumpedonproperty.com and click that book your free strategy session button. But either way, we wish you all the best on your journey as an investor to financial freedom.